Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, look at some information on Twitter. I'll give you my financial opinions as we go through it. And again, if you want to follow me on Twitter, it is at finding_finance, and you can follow me there. So let's start going through it. I posted this again. I think this is the second time I posted this up. It says the best stock trends after their breakout. So identifying the breakout is merely the entry point to the trend. The attributes of a high quality stage 2 breakout stack the odds of finding big winning stocks. And right now we have setups that are exactly like this on like 10-year timeframes. Some of these can be diversified mining companies. A lot of them are found in commodities. So we're right at point A and or this back test here, and some of them have actually come back into the pattern a little bit. So we've got a whole bunch of these setups. We also have a whole bunch of what I call the double bottom. You come in with the lead in, I call this the lead in move, and then the double bottom. This can be a slingshot, and then it slingshots higher back up here. We've got a lot at point A and point B right now. And some are even down here where they hit their head and they kind of came back. There are some companies that we are trying to pick the bottom down here, right in this general vicinity, for which would be the ideal entry point for a very patient investor, because sometimes it stays down a little bit. But that can be found on the website. A lot of picks. I've highlighted those picks. I talked to them through video, and I highlight the pattern and describe the pattern. So we've got that going on. We've got platinum versus silver. Credits to, I guess, myself. Many are bullish on silver, and you should be too, but you should be looking at platinum. Here's the setup here. This is the platinum to silver ratio, and you can see he ran a trend line through here. We have another one there, and then we've got another trend line here. We're just breaking out to the upside of the platinum to silver ratio. Platinum could go ballistic here at some point to the upside, where platinum outperforms every single precious metal there is. And one of the charts I wanted to show you is the platinum to gold ratio from the 1900s. This is in German, but this is the platinum to gold ratio from 1880 all the way till today. I don't have the 2022 data, but there's a couple of things I want you to notice in this chart. We are squeezing up into a corner, and the current ratio is over here. We've got the three humps. First one, second one, and then the third. And this is a ratio chart. And if you notice, this ratio traded in the 1920s during that hyperinflation above 5, almost to a ratio of 6, meaning that platinum traded at 5 to 6 times the price of gold during that time frame. We could see a vast outperformance of platinum versus gold and versus silver and versus palladium over the next decade, where we could see a massive outperformance. And if people think that gold's going to go to, I don't know, let's just say $4,000 an ounce, if platinum goes 5 times that, and I don't know if it's going to do that, but if it does, you're talking $20,000 an ounce platinum. And historically, platinum, it's common to see platinum trade at 5.5 times the price of palladium. And if palladium's at $2,000, then yeah, $20,000 seems actually doable, depending on where all these things go. But that's something I wanted to share on the platinum front. Here's one. It says, Marian Katusa, it says, over the past several years, uranium has been one of the best performing commodity investments out there. Over the past 5 years, physical uranium has appreciated over 100%, far outpacing other commodities like gold, copper, and oil. And I know the sentiment in uranium has been pretty negative, but it's actually performed quite well, the commodity itself, over the last 5 years. We've had a pretty big pullback in oil. Gold's been quite strong, and then we've got copper that is lagging. I do think, looking forward, that we're going to see all of these appreciate. Every single one. It says here, a year ago, thought it might be relevant. Remember these big formations that take time, play it forward. Love walks down memory lane. It says Livermore cylinder discovery is the holy grail. Be it an index or a stock, they all follow the same path. And we've got the bullish Livermore cylinder here. We've got the 1, 2, 3, 4, 5, 6, 7, and then you do the break. Boom. This is Enron back in the day. Enron was a fraudulent company that was basically cooking the books. They were logging ideas in the future and taking cash flows in the future and doing a net present value. Apple has that same type of formation. 1, 2, 3, 4, 5, 6, 7, boom, gone. And we've got the nice little circles here that are also present, and that we're probably doing a topping pattern, and that a gigantic commodity bull market's going to come, because that's what is going to force Apple and these other technology stocks lower. It's their inputs going up in price. But the patterns are all there. They can be found, and we can see them, and they're probably going to top at some point for these technology companies as interest rates go higher. I put these on here and retweeted, I should say. If it's second half 23 or later, that suggests we have not seen the whoosh in commodities and late cycle value that is consistent with high nominal inflationary emerging market regimes. Inflationary recessions create monetary illusions. So my friend recently wrote about how rising real incomes are not consistent with recession. Yes, and yet the consensus is firmly for recession, with some strategists and investors convinced we may already be in one. Yeah, there's a lot of data that is conflicting, and I think that's because the stimulus money is sending false signals. What's happening is we were firmly in the beginning of an expansionary phase of real estate. That stimulus money, I think, dragged interest rates to a level that was not sustainable by the expansionary phase of real estate. So the real estate market is literally in limbo. It's stuck because of interest rates being too high for the sustainability of it. Historically, that hasn't been the case because real estate has been the driving factor. It's been what limits interest rates and how fast interest rates and how high they go. This is stimulus money that's doing that. So I think we're getting false signals. We are still in the middle of an expansion phase of real estate, and I think it will re-kickstart when interest rates get to a certain level. I don't know what that level is, and we haven't seen a complete fall off of the housing starts. So yes, we've seen a slowdown in sales volume. We've seen a slowdown in some of the hotter, more volatile cities have definitely pulled back, and we're seeing that pullback. I'm not denying that. What I'm saying is we are still in the middle of an expansionary phase. We are still in the middle of a large demographic looking to buy homes. That didn't go away because pricing is high and interest rates are high, and the affordability is what is, I think, delaying the volume of sales. And that's all pushed by the stimulus money coming out. So we are in the happy valley where inflation is sort of flatlining. By quarter 3, 23, inflation will be accelerating again and rapidly. What does Jay Powell do when CPI is in the teens? What does he do about oil breaking out over the Russian invasion highs? Ask yourself these questions now. And I agree. I'm a huge oil bull. I think we're going much higher. The market dynamics, the supply-demand balances are out of whack. And Paulo says, I encourage my friends here to grab a quiet drink and chew on what you think China looks like in a few months. They're about to export a lot of inflation in the Fed June timeframe, right when economists and traders all agree that U.S. core PCE is headed less than 4%. So we've got some macro, we'll call it divergences. People think that inflation is going to go down, but we're going to have these drivers in the market which are inflationary. And we're going to see what happens here. It's going to be a very interesting mix. Usually when we look at this data, when we look at the data, it's usually from a steady state. What does that mean? Steady state means that when demand kicks up, you'll see prices of something go up. And that's from a steady state. Right now, we're not coming from steady states. We've got stuff that's shut down, lockdown, restart, people that are pulling out of countries, which their production's not going to be steady. We've got stuff going all over the place, which is not from a steady state. So the signals that we get are going to be flying all over the place because we're starting stopping things. And these are large economies. They're not small little economies that are insignificant. They're massively significant. And we're moving things all around at very fast paces, including interest rates and stimulus money. This isn't like it was any time in history. We are interjecting demand, like China reopening, and that's going to come back rapidly. We also threw in a bunch of money that we've never seen before in quantities that we've never seen. So I think that a lot of these indicators work very well from steady state, where everything's steady in the system, demand slowly exceeds supply, and then you see price signals. But this is going to be whipsawing all of those signals all around. And I think it makes it a lot more difficult because we could be getting false signals, like the lumber price or some of these other ones. I mean, when somebody's on lockdown, a full lockdown, that may impact the pricing of some of these things. So Eric says, despite recessionary fears, China demand suppression, ongoing SPR releases, and a Russian November export surge, total global oil inventories just hit a new low. What happens next year when the SPR ends, China normalizes, and Russian production finally falls? We remain bullish. I remain bullish too. Here we are at a total global oil held in inventory at a new low. We are still drawing down inventories, even though we threw everything in the kitchen sink at this thing to raise inventories. How is that possible? Now, prices are very low because they looked at the SPR releases as supply, not as inventory draws. So this is going to end, and it's going to get real interesting here. We know the Saudis are out of spare capacity. They said it. They came out and said, hey, look, we're going to be out of spare capacity here. They've got some investments where they might get 1 million more barrels per day out in 2027, but I think they're reaching exhaustion of some of their fields. Oil shale came out, and some of the CEOs of the oil shale said that we're probably going to be peaking here within the next 5 years. This is going to get real interesting here over this next bull market, because we're going to hit global worldwide oil production peak probably less than 10 years, probably less than 5 years. We could have already maybe hit it in 2018. We'll only know if we look back. It says oil is going to murder every single non-energy CUSIP in 2023. It says if oil runs to 100 plus, Jay Powell ain't even close to being done. Long commodities, short everything else. I completely agree. If oil is screwed in this economy, and we run big time to the upside, there isn't much that's going to work. I think what's going to work very well is obviously oil, natural gas, and uranium, and all the energy, the whole energy sector, coal. I also think the shipping companies are going to do very well. They seem to be highly correlated with oil. And then I also think that we're going to see precious metals be a store of value if currencies start to have problems. And that's kind of my whole portfolio there. It says, who is ready for $200 oil? So this is another chart. What he did is he took a top trend line, bottom trend line, which are equal trend lines, and then projected forward. We've basically broken the consolidation pattern, much like we did right here in the early 2000s. Move on higher, and I think we're going to move all the way to the top at $235 a barrel, $250, $300, something in the lines of that. That one's got $215. That's what's coming, guys. That's what's coming, in my opinion of it. Now, another thing that I was watching some real estate experts talk about the 18-year cycle. The 18-year cycle, we are basically in the same spot as 2001, about 2000, 2001. That's what they're saying. And this correlates very well with what we're seeing in uranium, oil, and all these other things. And that's what I really like to see, is that confluence of information, all kind of aligning. I don't think a lot of people understand the real estate cycle that are financially driven, and I think that they're messing it up. I still think that that's intact. We haven't seen a complete blowout crash in housing starts. As long as housing starts remain resilient and the stimulus money kind of works its way through the system, I think the housing starts will kick back on. That's me speculating. That's me speculating based off where we are in all of these charts, which is basically kind of the 2001 timeframe. I put this on here. It says, according to active listings on Realtor Monthly Trends Report, this is where we are with existing real estate inventory levels compared to history. We are here where the star's at. We are lower than everywhere else. That is what makes me think we're still in an expansionary phase, but it's basically just muted from the interest rates going up so high and so fast, from the stimulus money. And here is the active listing count. We are still very, very low. I know you're going to compare it to these, which were basically off the charts to the low side. We are still incredibly low with only 751,000. That's about a little over 2 months of inventory. That's it. And I know some areas are obviously worse than that, obviously, but that's world or nationwide. I said, what should be my next move? I was just trying to gauge. Buy oil and natural gas, looks like it won. Stay cash or buy physical metals. Pretty close with physical metals. I know some people voted for uranium, but I've got here, are you ready for the aluminum shortage coming? The deficit's now moving at such a speed that it's unsolvable, actually, he said. And we've got an aluminum deficit coming. 2023 is the inflection year. The inflection point is when all of the squeezing starts to happen. It may take a little bit, but I don't think there's much inventory of aluminum out there. So it could squeeze pretty quick. So I think there's a good investment opportunities out there in aluminum. But that's what I've got for today, guys. I am going to run a training session on technical analysis on the website. That's going to be held Thursday. I'm going to run it. It'll be Thursday at 5 p.m. So Thursday, 5 p.m., Mountain Standard Time. If you want to become a platinum member, become a platinum membership. It's at finding-value.com. Use the word discount in the coupon code to get a discount, and then we'll be doing that technical analysis training. All right, guys, that's all I've got. Give me a thumb up for the content, subscribe to the channel, and we'll catch you next time. This is Finding Value.